All right, so Chapter 8, Accounting for Long-Term Assets. Now, these are assets that provide or have a useful life that the company benefits from for more than one accounting period. And so let's talk about the cost principle as it relates to plant assets. When you have assets that uh, the company benefits from for more than 1 year, you're obligated, you're required to capitalize those assets. Capitalizing the assets means that you put the cost of the asset on your books as an asset, and over time, over its useful life, you account for the cost of the asset. All right, so when there's different types of assets, there's plant assets, sometimes called property, plant, and equipment. There's intangible assets, and there's also natural resources that are accounted for as well. And they're accounted for differently, but even though it's accounted for differently, it's still the same idea. You're recovering the cost of an asset over its useful life. All right, so what's a plant asset? Well, it's tangible property. It's actively used in the operation of a business. So like the facility, the building that you run your operations out of. You're not selling that building in your operations. You're using the building to do whatever it is you do. And here again, these are long-term assets because you expect to benefit over more than one period. And so when you account for the cost of a plant asset, you account for not only its cost, well, we'll talk about that in a minute. Anyway, you're going to calculate the cost. We'll talk about that in a minute. And you're going to allocate that cost over the business's useful life for that asset. So the asset's estimated useful life. You might, if you have subsequent expenditures, you might have to either expense those or capitalize them, depending on the type of expenditure it is. And then if you dispose of the asset, you're going to have to deal with that as well. All right, so what are the costs involved? Well, certainly it's going to be the purchase price, the invoice price for the asset, but cost includes all costs to get the asset to its intended location and in its intended condition, its intended use. And so it includes all normal and reasonable expenditures necessary to get the asset in place and ready for intended use. So such costs of property, taxes, transportation charges, insurance while in transit if the buyer pays them, the cost to install, assemble, and test are added to the purchase price, and the total costs are expensed, capitalized, and then expensed over the machinery and equipment's useful life. And so you've got different types. What they're showing here is different types of property, plant, and equipment. So these are some things that you would have with machinery and equipment. Here, buildings. You know, if you buy an existing building, you might have some what they call build out to get the building to its proper use. If it's a brand new building, you're going to have the cost of the purchase or the cost of construction. Uh, Either way, if you build or buy, you're going to have some closing costs, title fees, brokerage fees, attorney's fees, and taxes. Land improvements. You buy a piece of land that you're using in your business, and so let's say you have to build a road over it and construct a parking facility. And you got other things there, fences, sidewalks, shrubs, lighting systems. You capitalize all those costs and depreciate them over each asset's useful life. As far as land is concerned, you capitalize the cost of the land, and that's going to include the purchase price and closing costs such as title insurance premiums, real estate commissions, title search and transfer fees, surveying fees, and property taxes. But that cost is going to remain on the company's books until they sell the land. The point being that while other property, plant, and equipment is depreciable, land is not a depreciable asset, and the rationale behind that is that land has an infinite life, whereas other types of property, plant, and equipment don't. Now, if you have like a lump sum purchase, you've got to figure out or allocate the lump sum purchase to each individual asset that's purchased, and it's allocated based upon its relative fair market value. And so you've got a situation here where this CarMax paid $90,000 cash to acquire a group of items consisting of land at $30,000. That's the appraisal amount. Land improvements appraised at $10,000, and a building appraised at $60,000. So you're going to take those appraisal amounts, add them up. Notice that the appraised amounts are $10,000 more than what they paid for it. And so you're going to take this $90,000 and you're going to allocate 30% to the land, 60% to the building, and 10% to the land improvements. They did it a little differently down here. I'm not sure. I don't agree with him on this. Because I would segregate out the land improvements from the land, because you're going to have to depreciate the land improvements. That's why you're going to have to break those out. I'm not sure why they're doing it like this. Should be 60, 40, or 60, 30, and 10 for the land improvements. All right, let's look at how we compute and record depreciation using the different methods involved. We saw this in an earlier chapter, but let's talk a little bit more about it. And so remember that depreciation is a way of allocating or matching an expense, a prepaid expense, with the related revenue that is earned from this asset. And so when you buy the capital asset, you place it on your balance sheet at its cost, acquisition cost, and over its useful life, you expense the cost of the asset. Now, understand that the cost minus the depreciation is going to be what they call the book value of the asset, and understand that the book value of an asset does not necessarily equate the fair market value of the asset. Over time, the book value of the assets going down for each respective capital asset, whereas the fair market value of that asset may actually go up over time. So book value has nothing to do with fair value. You're not trying to indicate what the fair value is with this depreciation process. Two different concepts. All right, so the factors you need in computing depreciation is the asset's cost, the estimated salvage value, as well as the estimated useful life of the asset. And you have three methods. The straight line we've looked at before, but we'll look at again. Something called the units of production method, and then what's called the declining balance method. There's a couple of them. There's the double declining balance method and the 150% declining balance method. All right, so we have this asset that costs $10,000. We estimate the salvage value to be $1,000, and so the depreciable cost is $9,000. The estimated useful life is 5 years, and so we can look at units of production, the units. Not sure what they're trying to do here. Look at the example in the book. Some sort of thing that inspects shoes or something like that. All right, so anyway, 36,000 shoes are inspected. All right, so to determine straight line method, you simply take the cost minus the salvage value as your numerator, that's the 9,000, and you divide that into the 5-year period and come up with $1,800 per year depreciation expense. And so here we have an example of after 2 years what the balance sheet's going to look like. Your accumulated depreciation, which is the total depreciation for 2 years, is going to be $3,600, which is going to make your book value for this asset $6,400. Now, each year under the straight line method, you're depreciating the same amount, and at the end of the 5-year period, you're going to end up with your $1,000 on the books, the same as your salvage value. Now, let's move to, so here's an example of that. And so notice the depreciation rate is 20% every year. Let's talk about units of production. Here you still have the same numerator, cost minus salvage value. And to figure out step one, depreciation per unit, you're going to divide the 9,000 in our example into 36,000 shoes inspected, or whatever that was, to come up with depreciation per unit. So 9,000 divided into 36,000, so that's going to be 0.25, 25 cents per unit, depreciation per unit. And then in step two, to figure out your depreciation expense, you're going to take that 25 cents. Well, the total units of production is not 36,000. It's whatever it is per year. The total units of production over the life of the asset is 36,000. And so I take that back. The total units of production here is still going to be the 36,000, and you're going to come up with 25 cents per unit, and then so it's 25 cents per unit. And here's where you get into the number of units produced in the period. Okay, so 36,000 is the total over the life that's expected to be produced of a certain unit, whatever it is you're producing. And then this here, the number of units produced in the period, is the actual number of units produced. So 25 cents times whatever that amount is. And here the assumption is that 7,000 units were inspected during the first year. So you're going to take and multiply 0.25 times $7,000. And in that first year, you're going to depreciate $1,750, leaving your book value at 10,000 minus 1,750, which is 8,250. So here's what that looks like. All right, so this is based upon the actual depreciation expense is based upon the per unit depreciation amount times the actual number of items produced during a particular year. And so notice that for units of production, it can fluctuate based upon the amount of units produced per year. But notice this. At the end of the 5 years, for both units of production and straight line method, you're going to end up with the total amount of depreciation over time, meaning $9,000, leaving a book value at the end of 5 years under both methods of 1,000. Now, with the double declining balance method, we have 3 steps. First, you have to figure out what the straight line rate is per year. And based upon our example, you're going to divide 100% into the useful life of the asset. Well, here it's 5 years. So every year you're depreciating 20% of the life of this asset. You're going to take that percentage that you calculate in step one, and you're going to multiply it times 2 to come up with your double declining balance rate. Here it's 2 times 20%, so 40%. And then in step 3, you're going to take the double declining balance rate, in this case 40%, and multiply it by the beginning period book value. The beginning period book value is the asset's cost minus its accumulated depreciation over prior periods. Well, in step 3, for year 1, the beginning period book value is $10,000 because there's no accumulated depreciation yet. And so for year 1, you multiply the 40% times $10,000. Now, at year 2, what is your beginning period book value? Well, it's the 10,000 minus accumulated depreciation of 4,000, and so for year 2, you're going to multiply 40% times 6,000, and so that's going to be 2,400. And so that's what double declining balance method looks like over the 5-year period. Note here that in the usually in the last year, sometimes in the next to the last year, you're going to have this situation going on. You're going to calculate, if you calculate that last year and sometimes next to the last year's depreciation expense and deduct that, you're going to end up with a book value that's less than the estimated salvage value, and you cannot have that situation. You have to have, at the end of the 5-year period, in this case, only enough depreciation to reduce the book value down to its estimated salvage value, in this case $1,000. And so notice in this last year, they're only able to use $296 in depreciation expense. Whereas if you calculate that out, at the beginning of year 5, what is your book value? Well, it's $1,296, and you multiply that by 40%, and that's $518.40. Well, you can only out of that $518.40, you can only go down to $1,000. You can't go below. So you can only utilize $296 of that. So never depreciate book value below salvage value is the key. And again, notice even though you're computing different amounts for each year, except for straight line, it's the same. Overall, it's the same amount of depreciation, $9,000 under each. Notice the percentage down there of the methods used by companies. Far and wide, by far, straight line is the most used by companies. Now, under federal tax laws, they have their own special cost recovery method called Modified Accelerated Cost Recovery System that you will get to learn about when hopefully you talk about or study uh, income tax if you are an accounting major. If not, just know that for tax purposes, it has its own tax depreciation methods. Well, sometimes you purchase items in the middle of the year, meaning you're going to have a partial year's worth of depreciation. Sometimes you dispose of items in the middle of the year, and I don't mean exactly in the middle, but sometime between a full year. All right, so we have an example here. When a plant asset is purchased or sold during the year, depreciation is calculated for the fraction of the year the asset's owned. And again, you could do this a couple of different ways. Here, you have a purchase on October 8th, and I guess they just round it to the beginning of October here. And so in this case, for the first year, 2016, they're only going to have 3/12 because they only own it 3 years out of the whole year of 2016. So first year, only 3 months. You take your numerator, $9,000, and divide it into 5. So you've got your 1,800, and multiply that by 1/4. So you come up with 450. Now, these are estimates, both salvage value as well as the estimated useful life. When those estimates change, you simply make the change and depreciate the remaining book value going forward. So let's look at that. Let's see. So our machinery from the previous examples, we're going to assume that at the beginning of the asset's third year, its book value is $6,400. Okay, so the 10,000 minus the 3,600 accumulated depreciation using straight line method. At that time, it's determined that the machinery will have a remaining useful life of 4 years, so 2 more years. And the estimated salvage value will be revised downward from 1,000 to 400. And so you're going to take the remaining book value of 6,400, subtract the new estimated salvage value of 400, and you're going to divide that into the 4 total years that you have left on this. Okay, so let me make sure I got this right. Okay, so it will have a remaining useful life of, I guess what they're saying here is it's going to have a useful life of 4 more years. So they're not real clear on this, but what they're saying is at the end of the year 2 or the beginning of year 3, you've got 4 more years of useful life. So it's not shortened to 4 years, it's extended 4 more years from, so it's instead of it being a 5-year useful life, it's a 6-year useful life. That's what they're trying to say there. And so you've got 4 more years. That's where you're getting your denominator from. If it had, if they had said it only has a it only has a useful life of 4 years. I guess the operative word is remaining useful life of 4 years. If it was just 4 years, then you'd have to shorten it by 1 year, and that a revised remaining useful life would be 2 instead of 4. So anyway, that's why the denominator is 4. So 6,400 minus 400 is your numerator. Denominator is 4 years. You're going to, from starting in year 3, you're going to depreciate 1,500 per year, not 1,800. On the balance sheet, here's how you report depreciation. You're going to list your assets, subtotal the gross amount of those assets. Here, property and equipment gross is $1,057,475. And then after that, you're going to subtract your accumulated depreciation for those assets. And that, what that comes up with is the property and equipment net. Now, what can you gather from looking at this, just to kind of check your analytical skills here? The cost of these assets was $1,057,000 and some change, and you've got accumulated depreciation of almost $885,000. Well, what I gather from that is that they have a bunch of assets in their property, plant, and equipment that are almost fully depreciated. What does that tell you? Well, it tells you that they may be in the market for acquiring some new assets pretty soon, capital assets pretty soon. All right, let's take a break here and I'll come back and talk about revenues and capital expenditures.